My house gains $250,000 in value. I'm going to sell it, move across the street, use the proceeds to buy that lift, and you could make an extra $250,000 tax-free, or $500 if you're married, if you did it every 2 years.
So if you're someone thinking about buying or selling a home or is looking for more great information about all things Northern Nevada, by all means, please subscribe to the channel, hit the bell so you'll be notified. We have great videos and content coming out every week. And just know that we're here to support you and get you the information you need to know what's really going on about the real estate market and all things Northern Nevada. Today, we're going to talk about taxes and how they potentially can affect your real estate needs. And if you're someone that is thinking about opening or already owns an existing business here in the state of Nevada, there's a lot of ramifications regarding taxes in the real estate business. There's a lot of taxes that are just benefits here for being in the state of Nevada and some other things, whether you're thinking about opening a business or you're already an entrepreneur here. Today, what we did is we brought in Tim Nelson from Evans Nelson CPAs. He has been my CPA for as long as I've ever been in business. I've known him forever and ever. So Tim, thanks for coming on.
Absolutely. I think it's 20 years now.
Has it been 20 years? You've been married to Emily longer than that.
2004, I think. Didn't you open up the brokerage?
Oh yeah, well, I mean, it's been a long time. So I've known Tim forever, and we're going to just basically start with, the best and most well-known tax advantages, just basic. Most people know these, but what are some of the biggest and best tax advantages about just being in Nevada in the first place?
So we get a lot of that being so close to California, especially here in Northern Nevada. Everybody talks about Nevada doesn't have any state income tax, either for personal or corporations. If you're coming from a place like California, you're automatically saving the state taxes that you'd be having. Things like payroll taxes are lower, things like sales taxes a little bit lower, property taxes. So you name it, we save on taxes, and Nevada's really this business-friendly state.
So is there something specific? Let's go with income taxes first, because I realize I have a lot of people and clients who came from California. I have friends whose kids moved to California, and then they get that first paycheck and they're like, oh my God.
Yeah.
And so how big of a deal is it, and how non-income taxes in our state work compared to we use California as an example, but just generally.
Yeah, so if you're coming from a high-tax state like a New York or a California, like California, for example, because you said that, it's about 9% on average for most people. So if you talk about, you got $1 and an extra 10%, call it's going out to state income tax, and you're not seeing any of your taxes, it's huge. If you're coming from one of the other states like a Colorado or, one of the Midwestern states, those are, usually between 4 and 5%. But if you can get a 4 or 5% raise, or in California, a 9 or a 10% raise by moving across the border, super important and impactful to your bottom line, to your own personal income.
And does that matter? So for example, I know some people who, because now everyone's jobs are mobile, it seems like, if your company and your job actually is in California, but you're doing it from Nevada, where are you paying tax?
So if you are working for a California company and your butt is on the Nevada side, and it's a service-based company, right, so true, then technically you're supposed to be taxed only to Nevada, which there's no state income tax. Conversely, if, for example, I'm driving up to Truckee and doing the tax and doing a work up there, whatever it is, because my butt's on that state line, even though I might be a Nevada resident, I get taxed to California.
Okay, so this is something where people are thinking about switching jobs, or where their job might happen to be, because I know now so many people are working from home. I mean, your kids are on their 20s. And we were in our 20s, this was not a thing. But now it is kind of important, not necessarily where your job is and where you're doing it from. There's some things you got to think about.
Yeah, especially as California has its kind of budget issues. I always say colloquially, California hasn't ever collected a dollar it already hasn't spent.
Right.
And so some of the stuff that they're doing, even for services, California changed their law a few years ago for services that says most states tax you to where the service is actually being performed. California taxes you where the service is being benefited. I'll give you an example. If I prepare a tax return for a California resident, California now says Evans Nelson and Company did a California sale and should be required to file a California tax return because the tax benefited the California resident.
So that's as far as how your business goes.
Yeah, and any service-based business. So if I'm an engineer or an architect that does work up at the lake on the California side or that kind of thing, California will say that the Californian person benefited. Therefore, the Nevada company, there's a really famous California Franchise Tax Board case where a lady in Oregon who never visited California prepared a bunch of tax returns for people in California.
Right.
And they whacked her for prior income tax and interest and penalties for services that she performed for California citizens.
Wow. See, so that's interesting because I do know lots of real estate agents who have licenses in multiple locations, and even people live in Reno because obviously Lake Tahoe is kind of half and half, California and Nevada. So it could be someone like me. I don't have a California real estate license, but for some people, you could be selling in both places. And I guess that would make my tax a little more complicated if I were selling homes in both places.
Yeah, and usually that one's a little bit easier for agents and brokers, that kind of thing, because the brokerage is paying the commission, or rather the title and escrow company that's paying the commission will tag that as a California sale.
So are there anything specific as far as credits or things that would be something specific to Nevada versus that is not available in other states?
In terms of tax credits, it really the avoidance of extra taxes and fees and that kind of thing. So there's no special stuff. Sometimes you can get incentives on sales tax, or you can get incentives on payroll taxes, but usually it's an overall either avoidance of the tax entirely or a lower rate on the taxes that you're incurring by being in Nevada.
And then let's go talk a little bit about then on a business side. Obviously, I run a business, you run a business. We're both, lack of a better word, self-employed people.
Sure.
And so we were talking about how Nevada is pretty business friendly compared to a lot of other states. And so are there any benefits or economic advantages of you and I owning businesses here versus if you and I moved to some other state that we're doing business there?
Yeah, so Nevada views itself as a super business friendly state. So they try and keep their hands to a large extent off of businesses. So in terms of privacy, a lot of states will require that you report who the owners are. Nevada says, sorry, you got to report who's in control, who's managing the company, but not necessarily who the owners are. In terms of corporate taxes, up until you get over a $4 million revenue threshold, there really isn't any entity level tax at the state of Nevada. Workers' compensation. I've consistently had businesses that will be doing business in Nevada and then want to open up a operation in South Lake Tahoe, for example. The workers' compensation is 4 times what it is over here. So there's a huge amount of unseen, really not talked about benefits to doing business in Nevada and sourcing. I always say people who are forming their entities, if they're on the East Coast, they tend to form their entities in Delaware. That at least historically was true. On the West Coast, pretty much consistently, they're forming it in Nevada. And that's, lightened a little bit as people are doing business in multiple jurisdictions. But by and large, people, even if they're doing business in another state, might form their entity in Nevada because of the advantages that they get.
So it helps them obviously in talking with either a lawyer when they're setting up their entities or a CPA on figuring out what the best ways to set these up, especially if they're doing business in multiple states.
Absolutely. Yeah. The entity structure is huge when you're getting into it because it matters what you're doing, who you're doing it with, how you're doing it, as to what entity you're going to form, and then what jurisdictions you should play in.
So are there any specific unique tax things like that, for a business that maybe you get here that you wouldn't get in, say, the surrounding states?
In the state of Nevada, there's, benefits for doing business in the state of Nevada. Yes, privacy. We have better liability protection from an overall standpoint, kind of less touch on that in almost any ways in which an entrepreneur might do business.
If you're someone out there thinking about buying a home in Northern Nevada, but you're nervous and scared about pricing, affordability, and you're just not sure what's going on in the real estate market right now, hit the link. We have a free guide that gets you all the information you need so that you can feel comfortable about what's going on out there, and you can make an appointment directly with me so we can talk to you about helping you feel good and comfortable about what's going on in the real estate market here in Northern Nevada. Let's go towards a little real estate angle a little bit more. I know there's impacts of estate planning and inheritance planning. I know a lot of times we get people that call us to help them sell a home because grandma passed away. And a lot of times there's multiple siblings involved. Maybe those siblings don't all live in Nevada. I don't know if that matters or not, but are there any things for people to be looking out for when we're talking about estates and tax planning when people inherit things?
Yeah, so if we're talking about purely estate tax or inheritance tax, the federal estate tax is now about $13.6 million, just over $13.6 million. So if I'm a married couple, I have to be worth $27 million or more before I start worrying about estate tax.
Right.
Now, when you get to $27.3 million or you're just over that threshold, the rate's 40%. So you could lose 40% of your estate over that $27 million. But Nevada doesn't have an estate tax or an inheritance tax, where some other states, I think there's 16 of them now that have either estate tax or an inheritance tax. Difference is estate tax taxes the dead person's estate. The inheritance tax taxes anything that the beneficiary might receive. So for example, if you're in Oregon's threshold for the state estate tax is a $1 million threshold, and it's 10%. So if you're worth $10 million when you die in Oregon, the state will say, all right, your $10 million minus your $1 million threshold is a $9 million times a 10% estate tax. You're going to be sending that 10% to the state of Oregon. Because there are 16 states that kind of do that, Nevada in that vein is a whole lot better. Now, you asked an interesting second question that we get a lot of times. You said, hey, grandma died and there's 3 or 4 siblings that, have to sell the family home, whatever it is. Presuming that grandma's under that $13.6 million, her estate gets a stepped up basis to the fair market value. So let's say she bought the house in 1962 for $10,000. And in today's world, the house is worth $700,000. A lot of people go, oh my God, we got $700,000. We're going to have this huge tax bill. Well, if she died within about 9 months, if the house is being sold within about 9 months after death, the IRS treats that sales price as equivalent to the value that when she died. So there is no income tax or really estate tax on the value of that home, and the recipients of that money kind of receive it tax-free.
Well, it's funny you say that because I know on occasion we'll get somebody who isn't ready to sell that home yet. And I just did one of these the other day where somebody said, hey, we need to know what the value of the home would have been if we sold it 8 months ago so they could get that stepped up basis so that eventually if they sell it down the road, I'm guessing in 4 or 5 years, they would go off of it was worth $700,000 in 2024, but we sold in 2030, and then there'd be a little difference there?
Exactly correct. Yep.
Okay.
Yeah. So it goes up to the value of the date of the death, and then any increases from there is a responsibility of the beneficiaries. Well, let's do the converse. Let's say grandma knows she's dying, and she sells the house for $700,000 3 days before she dies. Well, she has to use that $10,000 cost basis. She'll have a huge tax liability, which all the estate will have to pay before any proceeds get distributed to the kids.
So in those cases, you're better off just waiting. And in most cases, it's pretty rare that I ever hear that. I mean, it would be a fluky thing where someone went to sell their house, and if they were going to die, it wasn't because they were sick. It was because something fluky happened and they had an accident or something weird like that, because most people would know to plan for that. You're typically not going to sell a home if you're sick and you're about to.
But that's the biggest thing I think I can tell you is that if you're thinking about doing something big like that, kind of ask your subject matter experts, because you want to know about it beforehand before you do something that's crazy.
Absolutely. As someone who's the trustee of a few people's estates, I haven't had to deal with it yet, but at some point I will have to. And those are the things you want to ask the questions before you do anything. So you go from there. So with that being said, we're talking a little bit about things like capital gains right there. In Nevada, are capital gains treated differently? Because this is something we talk about, especially in the housing market, where obviously as an individual or as a couple, you have that $250,000 and $500,000 exemption on your profits that people think you can only use one time, but you can use it over and over and over as long as you've lived in it. 2 of the last 5 years is one of the rules I have to know. But as far as other like capital gains, once it gets past those thresholds, is Nevada dealt with any differently than some other places?
Let's deal with the first part of your question there with that primary residence exclusion. It's funny, the people that think that you can only use it once in a lifetime, that was the rule up until about 2002. Okay. And so the people that have been around for a long time, it was always, you got to buy a bigger house, you got to buy a bigger house, and then you get a once in a lifetime kind of exclusion.
Okay.
And then back in 2002, they changed the rules so that you could really do it that once every 2 years. And so if you were super smart, I'd be going to see Brian every couple of years and say, hey, my house gained $250,000 in value. I'm going to sell it, move across the street, use the proceeds to buy that lift, and you could make an extra $250,000 tax-free, or $500 if you're married, tax-free if you did it every 2 years.
Well, the same thing I tell people is, because it has to be your primary residence. So if someone were to go out, let's say over their career and bought a bunch of rental houses, what you can do, and this is a strategy I've seen people do, it's not the easiest strategy in the world, is you sell your primary residence, take advantage of this the best you can, and then they literally start moving into their rental properties, and every 2 years they just keep moving into one after the other, so that it would be considered a primary residence. And you can actually tell people, if it's 2 of the last 5, you can technically have 2 primary residences relatively quickly in that same 5-year time window. So I don't know if I recommend that, but it is something you see people do sometimes.
It requires a huge amount of self-control. And you're missing one thing, because if you have a married filing joint tax return, you're supposed to tell a husband and wife to move into 2 separate houses. Because if the gain's only $250,000, they could get each a primary residence. And again, super crazy to be able to do that, but possible.
So you can literally, if you have a husband and wife, they can literally both move into different houses, and in a 2-year time frame, both get them considered to be primary residences.
As long as each one of them is only $250,000.
Right.
Yep.
I mean, if the gain was more than $250 at that point,
and you don't want to live with your spouse, and that kind of thing.
Well, that's an ongoing joke.
If you have this huge self-control at that kind of thing, then you can really maximize stuff as long as you know what the rules are going forward.
It is one of the jokes I tell with clients sometimes when you have a couple and one person and they don't like the same things. And I always joke saying, well, we can just get you 2 houses. Yeah. I didn't realize there's actually tax benefits, so I'll have to add that into my comedic real estate skills.
And then the second part of your question was, what about capital gains in Nevada versus somewhere else? So Nevada, not having any personal income tax, there is no added capital gains tax. You're subject to the federal tax associated with that. But let's say you sold a house on the California side. Not only would you be subject to capital gains rates for federal tax purposes, but California doesn't have a separate rate for capital gains. It's your ordinary tax rate. So you could pay up to 13.1% on California gains as well as your capital gains at the federal rate. So you could lose another 13% of the proceeds from your house.
So this is why you see people trying to get out of their real estate holdings in California and move them to other states.
Yeah, I mean, again, tax situation. In fact, I even heard of a provision here in Sacramento, not passed yet, but California is talking about for the higher incomers, increasing that rate from a 13.1 up to a 18.1%.
I've heard that one too. So with all that being said, any recent, so like you were talking about that one law change in 2001, which is kind of early in my real estate career, so I've only known it the way that it is now. Any other like tax changes, something that people should be aware of or something new that they may not know about that is a good benefit as a tax thing for the state of Nevada?
For the state of Nevada, not huge tax changes. Our state legislature meets every other year. They wrapped up in June of 2023. They won't meet again until February of 2025. So at least as it regards to real estate, a lot of the stuff has kind of stayed the same for the 2020, end of 2023 and beginning of 24 years. Some of the things that they don't realize at a federal level, for example, there actually exists a 0% capital gains rate if your capital gains aren't high enough and your other income is. So like first 78,000, I think, for married filing joint of capital gains could be taxed at a 0% capital gains rates. The rule that we usually tell is we tell people 15%. If you're in the highest income tax bracket, then your capital gains federally go to 20%. But there's actually a very small window where you might be subject to a 0% capital gains tax rate.
Well, and this is why I tell people all the time, you need to be talking. You and I meet pretty much 2 to 4 times a year, depending on how my year is going. And so with that being said, I know what I'm supposed to do to keep track of or to help you guys keep track of, because again, I always say, what are the things that we recommend to people that say, how do they keep track of things to help you guys be able to help them benefit best when they're filing their taxes? And I'm lucky because again, you guys do my bookkeeping and my taxes. So we're in constant communication. And so I know I'm doing all the things to provide you what you need to be able to do the best for me to try to reduce my taxes as best they can. But what would you recommend to people that maybe they're starting from scratch or they're new business owners or they're just sort of getting to where their taxes are now more complicated to then they can do them themselves?
Yeah.
So what would you recommend to these people on the best ways to move forward with that kind of thing?
Well, people who are new in business, I will say new business is like a baby. When you have a brand new child, they don't give you credit. They don't give the child credit for years until they get about 2 years old. It's 15 months old. It's 17 months old. The reason for that is the babies are developing so quickly that you can't really, say that they're a year and 3 months, whatever. It's 15 months because the difference between 9 months and 13 months is huge in a baby. Right. Same thing happens for a business. In brand new, there's a whole bunch of stuff that you don't know. I call that unconscious incompetence. You don't even know what you don't know. And my goal is to get you from unconscious incompetence to conscious incompetence. You're still incompetent, but at least you're like, oh crap, there's a whole world out there that I don't know. And eventually, as you get going, you figure it out, right? The basic stuff, whatever it is you're going along, and that's conscious competence. And then when you've been in business as long as you have been, there's stuff that you look at and you go, that's wrong. I don't have to look at the detail. I have this sense. A lot of people will say, hey, he's forgotten more about real estate than I'll ever know, kind of thing.
Right.
But that unconscious competence, you can look at something and say, there's a problem here and we need to investigate it further. And so my goal as an advisor to business owners is get them to where they're competent and get them to be so good at that they can kind of look at that and say, I need to make a change here because I know something's wrong.
As a business owner, because you're just so focused on trying to keep the damn doors open and make sure you have enough income coming in to cover your costs and your expenses, what would be the things you would tell somebody to track, whether it's having an in-house bookkeeper, hiring someone like yourself, having a third party come and do it? Like, how can we help these business owners or people that are starting either business that already live here or that are moving here? Yeah. How can they best do all this stuff to prepare? Because I can remember the first time I went from making a decent amount of money to a much higher number, and I about had a heart attack when I realized, well, we didn't plan accordingly.
Right.
This was 20 years ago, and all of a sudden I was like, well, I owed. And so, I mean, the idea would be I don't owe, but I'm also not getting any money back. I know people think they're getting a refund, but it's like, it's because you overpaid. It's not because you're owed. So I know we're trying to keep that as
your own money back.
100%. And so what would you recommend that people try to do, whether it's just a person who's got a regular job or someone that's got a actual business? Like, what are some things we could tell them?
Yeah, so if they have a regular job, probably a once a year check-in is fine, as long as they are about the same. If they're changing jobs, if they, went up significantly, if they're going to get a huge bonus, whatever it is, it's kind of time to check in because something significant has changed. In a business, it's kind of the same thing that says, listen, be organized, have all your stuff up to date. If you do your bookkeeping the week between Christmas and New Year's to figure out what the hell's going on for the whole year, whatever it is, it's already too late. There's almost nothing you can do to change the trajectory that you're on. So if you can be organized, if you can get your bookkeeping, the value of a bookkeeper is uncalculable. Knowing where you're going, if you're doing it best practices, really last month should be done by the 10th or the 15th of the following month, so that you as the business owner can focus on going forward instead of looking backwards. So if something's big coming up or you're knowing what's that kind of thing, there's all things that we can do zigs and zags. So your goal is to make as much possible money as possible, know where it's going, know what you're kind of doing, and then my job is to make sure that we use the income tax laws and the financial and economic laws to not only minimize the income tax, but to keep as much money in your own pocket as possible.
And it's funny you say that too, because I know I tend to buy a car and drive it forever, but about every decade or so, Tim will give me the whole, hey, if you need a car or you need these things, this might be a good year to do it. And I know, the whole 6,000 pound rule, and there's all these other rules that people they're not always aware of. You have to have someone that is in your court that is advocating for you, and you got to plan. That's, like I said, it's just a lot of planning that goes on involved in your taxes. So Tim, I appreciate it. I know people we're talking pretty fast about a lot of these things.
Sure.
And if you're looking for more information, you can reach out to me. You can reach out to Evans Nelson CPAs. If you're someone thinking about buying or selling a home here in Northern Nevada, or someone's thinking about moving here, click the video, check it out. We've got lots of great information for you.